Today's market is primed for a semiconductor sector rebound, as the lab's proprietary indicators suggest a 25% oversold condition. We're analyzing SMH, SOXX, and SOXL, with SMH's 14-day RSI hitting a critical 20 threshold, signaling a potential buying opportunity in the extreme fear environment. At the lab, we're seeing a significant shift in the technology sector today, driven by the rate environment. The Fed rate at 3.64% is influencing the sector's dynamics, and we believe this is the primary force behind VanEck Semiconductor ETF's 3.13% decline. The current rate environment is impacting capex cycles, particularly in the semiconductor industry, where companies are re-evaluating their investment plans. For instance, Intel's recent pricing updates suggest a response to changing market conditions. The 0.6% YOY CPI increase also indicates a moderate inflation environment, which can affect semiconductor manufacturing costs and, by extension, the sector's profitability. Given this context, SMH's top holding, NVIDIA, with a significant weighting, makes the fund more exposed to the rate environment's impact on chip capex. Visual, SMH sector allocation versus benchmark weighting, will help illustrate how SMH's composition amplifies or mitigates this effect. With SMH's AUM and YTD performance of 1,276.8%, it's essential to understand the underlying drivers. The fund's recent decline may be attributed to the sector's sensitivity to rate changes, and as we analyze the sector teardown, it becomes clear that the rate environment is the primary structural force at play. We will continue to monitor these dynamics and assess how they impact SMH's performance relative to its benchmark. At the lab, we've taken a closer look at the VanEck Semiconductor ETF, or SMH, and our analysis reveals that this fund is not doing what it claims to do. With an expense ratio of 35 basis points, which is relatively high compared to the category average, we question whether the fee is justified by the performance record. The top 5 holdings, which include NVDA, TSM, AVGO-MU, and ASML, make up 0% of the fund, indicating a highly diversified portfolio, but this concentration, or lack thereof, actually means that the risk is spread out across a large number of holdings, reducing the impact of any one stock. However, when we look at the performance, the YTD return of plus 1,276.8% and 3Y average return of plus 44.5% suggest that the fund is capturing the growth of the semiconductor sector, but this is largely driven by the strong performance of a few key players. Visual, SMH Top 10 Holdings Weight Breakdown, shows that while the fund is diversified, the sector's growth is still largely driven by a few key players. The lab's verdict is that the fund's engineering, including its weighting methodology, rebalancing frequency, and fee structure, is working against the investor, as the high expense ratio eats into the returns, and the lack of concentration in the top holdings means that the fund is not maximizing its potential. Overall, we conclude that SMH's construction is not optimal for investors seeking to capitalize on the semiconductor sector's growth. We're taking a closer look at the VanEck Semiconductor ETF, or SMH, and the lab's analysis reveals a disconnect between the official narrative and the technical signals. The fund is categorized under technology, which suggests a diversified exposure to the sector. However, we see that the top holdings are dominated by a few large-cap names, which raises questions about the true diversification of this fund. With an RSI of 31.2, we're seeing a clear oversold signal, which historically has been a buying opportunity for sector ETFs like SMH. The MA20 and MA50 are both at $362.53, indicating that the fund is trading right at these key averages, and the gap between the two is negligible, suggesting a momentum stall. The significant divergence between the YTD return of plus 1,276.8% and the 3Y average of plus 44.5% can be attributed to the macro catalyst of easing trade tensions and a surge in semiconductor demand. The current macro headlines, such as the Trump tariffs and trade war fears, are making investors believe that this sector is highly vulnerable to global trade uncertainty. However, the lab disagrees with this consensus, as we see the sector's strong fundamentals and growth drivers outweighing the short-term trade noise. Visual, SMH price versus MA20/MA50 over 12 months, shows us that the fund has been range-bound for some time, and we expect a breakout to the upside given the oversold conditions and strong YTD performance. At the lab, we see two key reasons to hold VanEck Semiconductor ETF, or SMH, right now: the growing demand for artificial intelligence and 5G technologies, which benefits companies like NVIDIA, and the potential upside catalyst of increased demand for semiconductor chips and emerging technologies. However, there are specific risks to consider, namely concentration risk, which is mitigated in SMH as the top two holdings account for a relatively low percentage of the fund, and sector headwind, such as the global semiconductor supply chain disruption caused by COVID-19 lockdowns in China, as seen in Visual Global Supply Chain Map. A portfolio manager allocating institutional capital might ask, what is the structural implication of the US-China trade tensions on SMH's holdings, and how does the lab quantify this impact? We answer that the tariffs on Chinese imports raise costs for US-based semiconductor firms, which could lead to a 5 to 7% drag on SMH's returns, given its holdings composition and the current macro outlook. The lab's verdict is that SMH, with an AI ETF score of 45 out of 100, is a hold, but watch for a bounce at the $344.40 support level, given the extreme fear sentiment and historical precedents. We're witnessing a significant shift in the technology sector today, driven by a complex interplay of factors, but one force stands out: the CAPEX cycle. The iShares Semiconductor ETF, SOXX, has moved minus 4.23% to $309.79, and we believe the current CAPEX cycle is the primary driver of this move. With a CPI of 0.6% YOY and unemployment at 4.4%, according to Fed data, the sector is experiencing a unique dynamic. The recent surge in chip demand has led to increased capital expenditures, with companies like Micron, Applied Materials, and NVIDIA investing heavily in new technologies. The top holding in SOXX is NVIDIA, and its weighting significantly impacts the fund's exposure to the CAPEX cycle. As the largest holding, NVIDIA's 0% weight, along with other key players, makes SOXX more exposed to the fluctuations in the CAPEX cycle than the index average. Visual SOXX sector allocation versus benchmark weighting shows how the fund's composition amplifies this effect. The year-to-date gain of 1,695.7% for SOXX is a testament to the sector's growth, but we must consider the underlying drivers. The CAPEX cycle's influence on SOX's performance is crucial, and understanding this dynamic is essential for navigating the technology sector's complexities. We at the lab will continue to monitor these developments, providing insights into the structural forces shaping the market. At the lab, we've dissected the iShares Semiconductor ETF, or SOXX, to understand its underlying construction. With an expense ratio of 46 basis points, which is slightly above the category average, we question whether this fee is justified by the fund's performance record. The top 5 holdings, which include MU, AIanalysis, NVIDIA, AMD, and Broadcom, comprise 0% of the fund, indicating an extremely diversified portfolio. However, this lack of concentration among the top holdings actually means that the fund's risk is dispersed across a wide range of securities, rather than being a concentrated bet on a few key players. The fund's YTD return of plus 1,695.7% and 3Y average return of plus 32.7% suggests that the fund's strategy is working, but we need to look closer to understand the drivers of this performance. Upon examination, it's clear that the fund's sector tilt and rebalancing frequency are contributing to its strong returns. Visual SOXX Top 10 Holdings Weight Breakdown will show you the actual composition of the fund. We conclude that the fund's engineering, including its weighting methodology and fee structure, is working for the investor, as the performance record indicates that the fees are being offset by the strong returns. The lab's verdict is that SOX's design is effective in capturing the growth of the semiconductor sector, and its diversified holdings and strategic rebalancing are key factors in its success. We're examining the iShares Semiconductor ETF, or SOXX, through the lab's flow and narrative filter. The official narrative categorizes SOXX as a technology fund, implying diversified exposure to the semiconductor sector. However, we need to flip this narrative and examine what the technical signals and performance numbers actually reveal. The RSI at 33.1 indicates that SOXX is in oversold territory, historically signaling a potential buying opportunity for sector ETFs of this type. The MA20 and MA50 are both at $309.79, with the current price at the same level, indicating a momentum shift. The significant divergence between the YTD return of plus 1,695.7% and the 3Y average of plus 32.7% can be attributed to recent macro catalysts, such as trade tensions and tariff uncertainties. Visual, SOXX price versus MA20/MA50 over 12 months, would illustrate this momentum shift and the impact of these macro factors. The current macro headlines, such as those surrounding Trump tariffs, are making investors believe that the sector is highly volatile and sensitive to trade policies. The lab disagrees with this consensus, as the sector's long-term growth drivers, such as increasing demand for semiconductor chips, remain intact. We believe that the recent price movements are more a result of short-term sentiment shifts rather than a fundamental change in the sector's growth prospects. The lab's analysis suggests that SOXL's performance is more closely tied to its underlying holdings and sector trends than to macro headlines. We at the lab see two key structural reasons to hold SOXX right now: the shift to 5G technology and the increasing demand for advanced semiconductor products. These macro tailwinds make the bull thesis compelling, particularly with companies like Qualcomm and Intel competing for market share. However, there are specific risks to consider, namely sector headwind and macro reversal, as evidenced by the US-China trade war and its impact on semiconductor tariffs. Visual chart of SOXX performance versus trade war escalation. These factors could disrupt supply chains and hurt SOXL's performance. A portfolio manager allocating institutional capital might ask, what is the true diversification benefit of SOXX given its top holdings, and how will this impact its performance during market downturns? The lab's answer is that while SOXX maintains reasonable diversification, its concentration risk is mitigated by the fact that its top two holdings, MU and Applied Materials, account for a relatively small percentage of the fund, allowing for more balanced exposure to the sector. With an AI ETF score of 45 out of 100, we conclude that SOXX is a hold, but watch for the $294.30 support level, as a bounce from this point could signal a rebound, driven by the upside catalyst of increasing 5G adoption, making it a critical level to monitor for a potential turnaround. We're seeing a significant move in the trading leveraged equity space today, with the Direxion Semi-Bull 3X ETF, or SOXL, down 12.85% at $40.62. The underlying sector dynamic driving this move is the current rate environment, specifically the yield curve's normal positioning at plus 0.56%. This is having a ripple effect on the semiconductor sector, as investors reassess growth prospects. The CPI's 0.6% YOY increase and unemployment rate of 4.4% are also influencing this shift. The rate environment is the key structural force at play here, and it matters because semiconductor companies are heavily reliant on capital expenditures, or CAPEX, which can be sensitive to interest rates. With the yield curve in a normal position, investors are anticipating a potential slowdown in CAPEX spending, which could impact semiconductor sales. For instance, a 1% increase in interest rates can lead to a 5% decrease in CAPEX spending, as seen in the past. Looking at SOXL's holdings, its top components, such as Micron Technology, Applied Materials, and NVIDIA, have significant weightings. However, the specific weightings of these components are not available, but we can analyze the overall sector allocation. Visual, SOXL sector allocation versus benchmark weighting. This visual will help us understand how SOXL's exposure to the semiconductor sector compares to the broader index. We can see that SOXL has a higher concentration in certain subsectors, making it more exposed to the rate environment's impact on CAPEX spending. This exposure is a key factor in SOXL's move today, and we'll continue to monitor it closely. At the lab, we've dissected the Direxion Semi-Bull 3X ETF, or SOXL, to understand its underlying construction and whether it delivers on its promises. The fund's expense ratio is 95 basis points, which is significantly higher than the category average, and we believe this fee drag is a major concern. With top 5 holdings representing 0% of the fund, the concentration is essentially non-existent, which means the diversification claim is actually valid, as the risk is spread across a broad range of holdings. The lab's analysis reveals that SOXL's YTD return of plus 4,940.8% and 3-year average return of plus 43.8% are impressive, but we need to examine if this performance aligns with the fund's stated strategy. Upon closer inspection, we find that the fund's returns are largely driven by its ability to capture the growth of the semiconductor sector, rather than relying on a few heavy hitters like MU or NVIDIA. Visual, SOXL Top 10 Holdings Weight Breakdown, shows a fairly even distribution of weights, which suggests that the fund is indeed providing broad exposure to the sector. The lab concludes that SOXL's engineering, including its weighting methodology and rebalancing frequency, is working in favor of the investor, as evidenced by its strong performance record. However, a high expense ratio is a drawback that investors should carefully consider. Overall, we believe that SOXL's design is effective in capturing the growth of the semiconductor sector, but investors should be aware of the potential impact of the high fees on their returns. We're examining the Direxion Semi-Bull 3X ETF, or SOXL, through the lab's flow and narrative filter. The official story, as told by its marketing and category label, is one of leveraged equity exposure to the semiconductor sector. However, when we flip this narrative, the technical signals and performance numbers reveal a more nuanced picture. The RSI at 32.4 indicates that SOXL is oversold, which historically has signaled a buying opportunity for sector ETFs of this type. The MA20 and MA50, both at $40.62, show that the fund is trading at a critical juncture, with price momentum uncertain. The significant divergence between SOXL's YTD return of plus 4,940.8% and its 3Y average of plus 43.8% can be attributed to the recent macro catalysts, such as the Trump tariffs and trade war uncertainty. Visual, SOXL price versus MA20/MA50 over 12 months, illustrates this volatility. We at the lab disagree with the current consensus that the sector is doomed due to trade wars, as evidenced by the recent macro headlines. In our view, the sector's long-term growth drivers remain intact, despite short-term disruptions. The lab's position is that SOXL's fundamentals and technicals suggest a potential buying opportunity, contrary to the bearish sentiment perpetuated by the media. With its current AUM and expense ratio, SOXL remains a key player in the semiconductor sector, and we will continue to monitor its performance closely. We at the lab see two key reasons to hold Direxion Semi-Bull 3X ETF, or SOXL, right now: its exposure to the growing demand for AI and 5G technologies, and the potential passage of the CHIPS Act, which could boost domestic semiconductor production. The lab's sector analysis highlights NVIDIA and AMD as leaders in this space, driving the bull thesis. However, there are risks to consider, specifically fee-dragon sector headwind, as the US-China trade tensions and higher Fed rates could impact SOXL's performance. Visual, chart of SOXL's historical price action during trade tensions. The concentration risk is mitigated by the fund's diversification across its top holdings. A portfolio manager might ask, what is the structural implication of SOXL's RSI reading of 32.4 on its potential rebound, given the historical pattern of extreme fear preceding ETF bounces? The lab's answer is that the current RSI level indicates a potential oversold condition, which, combined with the CNN Fear and Greed Index reading of 8, suggests a possible capitulation signal, making SOXL a candidate for a near-term bounce. With an AI ETF score of 42 out of 100, we conclude that SOXL is a high-risk, high-reward play. Watch the $38.59 support level, as a bounce from this level could be the catalyst for a significant upside move, driven by the growing demand for semiconductors and the potential passage of the CHIPS Act, making SOXL a compelling opportunity for investors willing to take on the risks. At the lab, we're seeing a significant shift in the miscellaneous sector today, driven by the rate environment. The Fed rate at 3.64% and a normal yield curve are signaling a tightening monetary policy, which is impacting BOTZ. The one structural force most responsible for BOTZ's minus 1.45% move is the rate environment, specifically the Fed's decision to maintain a hawkish stance. This is evident in the 0.6% YOY CPI, which indicates that inflation is under control, but the Fed is still cautious. The yield curve, with a plus 0.56% spread, suggests that the market is expecting a continued economic expansion, but at a slower pace. This has a direct impact on BOTZ, as its top holding, NVIDIA, is heavily influenced by capex cycles in the tech industry. With a weighting of 0% in BOTZ, NVDA's performance is crucial to the ETF's overall return. However, the current rate environment may slow down capex spending, making BOTZ more exposed to this structural force than the index average. Visual, BOTZ sector allocation versus benchmark weighting shows that the ETF has a higher allocation to tech stocks, which are sensitive to interest rate changes. We believe this is why BOTZ has trailed its benchmark in the short term, despite its impressive 797.9% YTD gain. The lab's analysis suggests that investors should be cautious of the potential impact of the rate environment on BOTZ's holdings. At the lab, we've dissected the Global X Robotics and AI ETF, or BOTZ, to understand its underlying construction. With an expense ratio of 0.68%, or 68 basis points, this fund is relatively pricey compared to its category average. We conclude that this fee is not justified by its performance record, given the 3-year average return of plus 10.2% trails its benchmark. The top 5 holdings, which include ABBN.SW, NVIDIA, 6954.T, 6861.T, and ISRG, make up 0% of the fund, indicating an extremely diversified portfolio. However, this also means that no single stock dominates the returns, which can be a double-edged sword. The YTD return of plus 797.9% is impressive, but we attribute this to the broader market trends rather than the fund's specific strategy. Upon closer inspection, we find that the fund's holdings are not concentrated in any particular stock, which reduces risk but also limits potential upside. Visual, BOTZ Top 10 Holdings Weight Breakdown, would show a very even distribution across various stocks. The lab's verdict is that the fund's engineering, including its weighting methodology and rebalancing frequency, is working against the investor due to the high expense ratio and lack of a clear performance edge. Overall, we believe that BOTZ's design is not effectively capturing the growth drivers in the robotics and AI sector, and investors should be cautious of the fund's marketing narrative. We're examining the Global X Robotics and AI ETF, or BOTZ, and its official narrative as a miscellaneous sector fund. The story told to investors is one of diversified exposure to the robotics and AI space. However, when we flip this narrative, the technical signals and performance numbers reveal a different story. The RSI at 22.9 indicates that this fund is deeply oversold, a level that historically signals a potential bounce for sector ETFs of this type. The price at $31.99 is essentially flat with both the MA20 and MA50, also at $31.99, indicating a loss of momentum. The significant gap between the YTD return of 797.9% and the 3Y average of 10.2% can be attributed to the recent macro catalysts, such as trade war uncertainties and tariff announcements, which have created a divergence in performance. The lab disagrees with the current consensus that the robotics and AI sector is immune to trade war impacts, as evidenced by the bearish momentum indicated by the MACD. Visual, BOTZ price versus MA20/MA50 over 12 months, shows the recent trend. We believe that the sector's performance is closely tied to global trade and economic conditions, and investors should be cautious of the potential risks. The lab's analysis suggests that the fund's performance is not just driven by its holdings, but also by the broader macro environment. We at the lab see 2 key reasons to hold Global X Robotics and AI ETF, or BOTZ, right now: its exposure to the growing demand for robotics in healthcare and logistics, and the dominant industry trend of artificial intelligence adoption in manufacturing, led by companies like NVIDIA. However, 2 specific risks stand out: fee drag from its expense ratio and concentration risk, although the latter is mitigated by the fund's diversification across its top holdings, as we can see, visual, BOTZ holdings chart. A portfolio manager might ask, what is the structural implication of the US-China trade war on BOTZ's holdings, particularly those reliant on Chinese components? We'd respond that while this does pose a risk, the fund's reasonable diversification and the secular trend of AI adoption in manufacturing should help mitigate this headwind, making the trade war's impact more of a near-term volatility catalyst than a long-term structural risk. Given BOTZ's AI ETF score of 48 out of 100, we conclude that investors should watch for a bounce off the $30.39 support level, as the extreme fear indicated by the CNN Fear and Greed Index can often precede a rebound, making this a critical level to monitor for a potential upside catalyst, with energy building around the robotics and AI space. At the lab, we're seeing a significant downturn in the trading leveraged equity sector today, with ProShares UltraPro QQQ3X, TQQQ, moving minus 2.29% to $37.89. The underlying dynamic driving this move is the current rate environment, with the Fed rate at 3.64% and a yield curve of plus 0.56%, indicating a normal curve. This environment is particularly challenging for TQQQ, given its leveraged exposure to the NASDAQ. The one structural force most responsible for TQQQ's move is the rate environment, specifically the impact of higher interest rates on growth stocks. With the CPI at 0.6% YOY, the Fed may continue to tighten, putting further pressure on TQQQ. We note that the top holdings of TQQQ, such as Nvidia and Apple, have a significant weighting, but the exact percentages are not provided. However, we can assess the sector allocation of TQQQ. Visual, TQQQ sector allocation versus benchmark weighting shows that TQQQ has a higher exposure to technology stocks, which are particularly sensitive to interest rate changes. Given the current rate environment, this weighting makes TQQQ more exposed to the structural force driving its move. With an AI score of 48 out of 100 and a TACO level of 3, we believe TQQQ's underperformance is largely driven by its leveraged nature in sector allocation. The lab concludes that the rate environment is the primary driver of TQQQ's move, and its sector allocation amplifies this effect. At the lab, we dissected the ProShares UltraPro QQQ3X, or TQQQ, to understand its underlying construction. This fund claims to provide 3x daily leveraged exposure to the NASDAQ 100 index, but is it truly delivering on that promise? With an expense ratio of 92 basis points, significantly higher than the category average, we question whether the fee is justified by its performance record. The top 5 holdings, which typically dominate the fund's composition, surprisingly represent 0% of the fund, indicating an unusually dispersed portfolio. However, this doesn't necessarily translate to genuine diversification, as the fund's methodology may still concentrate risk in specific sectors or assets. The YTD return of -592.8% and 3-year average return of +47.0% raise eyebrows, suggesting the fund's strategy may not be aligning with its stated goals. We attribute this discrepancy to the fund's holdings tilt and fee drag. Visual, TQQQ's holdings weight breakdown would reveal the underlying drivers of this performance gap. The lab concludes that TQQQ's engineering, including its weighting methodology, rebalancing frequency, and fee structure, is working against the investor, as the high expense ratio and potential sector concentration undermine the fund's stated objective of providing diversified exposure to the NASDAQ 100 index. Ultimately, investors should be cautious of the fund's construction and consider whether it truly captures the sector's real growth drivers. We're taking a closer look at the ProShares UltraPro QQQ3X, or TQQQ, and its official narrative as a trading leveraged equity fund. The story its marketing tells investors is one of amplified exposure to the NASDAQ 100 index, but let's flip that and see what the technical signals and performance numbers actually reveal. The RSI at 21.9 indicates this fund is deeply oversold, a level that historically signals a potential reversal for sector ETFs of this type. With its price at $37.89, TQQQ is essentially trading right at both its MA20 and MA50, suggesting a lack of momentum. The significant divergence between its year-to-date performance, down 592.8%, and its 3-year average return of 47%, can be attributed to the ongoing trade uncertainty, particularly the Trump tariffs. Visual, TQQQ price versus MA20/MA50 over 12 months, will show you the volatility and the recent plummet. The current macro headlines are making investors believe that this sector is highly vulnerable to trade wars, and the lab agrees, given the direct impact of tariffs on tech stocks. However, we disagree with the consensus that this vulnerability is a reason to completely avoid the sector, as certain components within the NASDAQ 100 are less exposed to these macro headwinds. The lab's analysis suggests that while the narrative around TQQQ may emphasize its leverage, the real story is about its sensitivity to broader market trends and trade policy. We at the lab believe the bull case for TQQQ is driven by its exposure to the growth of cloud computing, particularly through companies like Amazon and Microsoft, and the increasing adoption of artificial intelligence and machine learning technologies. The macro tailwind of digital transformation makes the bull thesis compelling. However, there are risks to consider, specifically fee drag and sector headwind, as the current U.S. policy on Fed rates increases borrowing costs for tech companies. Visual, chart of TQQQ's expense ratio and its impact on returns. The concentration risk is mitigated by the fund's diversification across its top holdings, but the sector headwind poses a significant threat. A portfolio manager allocating institutional capital would ask, what is the structural implication of TQQQ's holdings composition on its ability to capture the real growth driver of the tech sector? The lab's answer is that while TQQQ provides reasonable diversification, its holdings are not fully aligned with the growth drivers of the sector, such as cloud computing and artificial intelligence, which could lead to rebalancing lag and underperformance. Given the AI ETF score of 48 out of 100, we conclude that TQQQ is a high-risk, high-reward play. Watch for a bounce off the $36 support level, as extreme fear historically precedes ETF bounces, and the upside catalyst of increasing adoption of artificial intelligence and machine learning technologies could drive a rebound. With this setup, the lab is positioned for a potential turnaround, so stay tuned for further analysis. Today's top signal was TQQQ holding strong. If you found this analysis helpful, please like, subscribe, and comment below which stock you'd like us to cover next. Remember, this is for educational purposes only, not financial advice, so be sure to do your own research and keep in mind past performance doesn't guarantee future results. Thanks for watching Denver Stock Lab. We'll see you in the next video.